Hello, everyone. Thank you for joining us today for this special edition of the Weekly Roundup. As we all know, tax season can be a challenging time, and we're here to help you try to navigate it with confidence. We are honored to have Peter Bowen, VP of Tax and Retirement Research at Fidelity Canada, with us today. Hello, Peter.
Hello.
Hello, Ben.
Hi, Eva.
Just a brief profile for Peter. He advises on complex tax issues and leads Fidelity's research into issues around planning for and living in retirement. Before taking this role, Peter served as fund treasurer for the Fidelity Mutual Funds for 17 years. He's the former chair of IFIC's Taxation Committee. And before joining Fidelity in 1994, he was principal in the tax department of PricewaterhouseCoopers, primarily advising the mutual fund industry. He holds the Chartered Accountancy designation and obtained a BA in economics from the University of Waterloo. Thank you once again for joining us, Peter.
Thank you, Eva.
Before we dive in, I just want to remind you that you can drop your questions in the Q&A box. During the session, we want to make sure you get the answers you need. I'm going to grab my pen and paper, and I'm going to hand over to Ben and Peter to enlighten us.
Excellent. Thanks, Eva. Peter, thanks so much for joining us today. Tax, maybe tell me why you decided that tax was going to be the direction of your career.
Well, that's a long story, Ben, but
Yeah.
I'll give the quick version. So after I got my CA, I moved out into industry working for Sears Canada, of all places, which
Okay.
has subsequently gone bankrupt, but
Yes.
not because of me. I was
Yeah.
only there 2 years. I was a financial analyst. It was a great job for a young kid at the time. And they talked to me about areas that I wanted to move into, and it really got me thinking. And they wanted me to go into tax, and I like tax. But I thought, if I'm going to do tax, I want to do it properly. So I moved to one of the big four audit firms where you get a much deeper training in tax. I spent almost 7 years there. And then Fidelity Investments came along and offered me a position, which I hadn't been looking to leave, but it sounded like a great opportunity. So I moved over to Fidelity. I spent a lengthy period of time as treasurer for the funds. And then I got the opportunity to take on my current role, which I've been doing since 2012. It's a long time, as head of tax and retirement research, and so it's brought me back to my tax roots. And it's one job since 2012, but taxes is always changing. So it's interesting and exciting for a tax geek.
Fantastic. Yeah. I mean, tax has changed a lot for sure. And maybe for others who don't know who Fidelity is, obviously a very big independent investment management firm based out of the US. Maybe a quick Coles Notes, if you can, just on the Fidelity Group.
Yeah, so we started in Canada in 1987. I think the first day of trading was Black Monday in 1987. For those of us old enough on the call to remember that. So it's been a wonderful growth story. We've got over 2,000 employees in Canada, well over $200 billion in investment assets that we manage on behalf of Canadians. Tremendous growth over the period of time that I've been there. We've got all sorts of different investment funds available for investment for investors, mutual funds, pooled funds for those with higher net worth. Lots of different options that will hold stocks or bonds or both, all across the spectrum.
Right on. That's great. Awesome. Well, I think we should jump into tax, and as you say, things continue to change and change at a quick pace. And there's a lot of gray and cloudy out there as to what's going on from a tax perspective. So, one of the questions I often get on about this year particularly is what's going on with the capital gains changes. So maybe I'll leave that open. I know that it's something that you're quite familiar with, so maybe I'll leave that open and you can tell me a bit about what it might look like, all the changes on the capital gains side, please.
Too familiar. Yes, it doesn't change as rapidly as tariffs, but it has been a moving target, the capital gains inclusion rate. So in last year's budget, call it a year ago, uh, the government proposed to increase the inclusion rate for capital gains. So when we sell an investment or a second property, not our principal residence, but a second property, for instance, or a business, and it's a taxable account, or shares of a business, or obviously a second property would be. 50% of our capital gain goes onto our tax return and gets taxed along with our other income. The proposal was to increase this to 2/3, 66 and 2/3%. Now, for individuals, there was going to be a very large $250,000 per year buffer, but corporations did not get that buffer. So the effective date was proposed to have been June 25, 2024. So it was actually a little window of time, and many taxpayers chose to actually trigger some gains if they thought they would be subject to that higher inclusion rate at a future date. So particularly, a lot of small business owners have investments in their corporations, for instance. So they might have sold some investments, prior to June 25. Well, along comes January of this year, and they postpone it.
Yeah.
So it's not effective as of June 25 last year. They proposed postponing it to January 1 of 2026.
Okay.
Now, that proposal is still technically out there, but, and it's a big but, two things. We now have a new leader of the Liberal Party, Mark Carney, who has said that he will not proceed with this.
Yes. Yeah.
And we're likely to have an election. So either, most likely either the Liberals will win it or the Conservatives. And if the Conservatives win it, they have said they'll reverse it. So the likelihood of this actually going forward is very, very low, I would suggest. Now, I will note that those people who sold assets prior to June 25 last year, too bad, right? They are paying taxes earlier than they otherwise would have. And they did nothing wrong.
Yeah.
Right? They did their tax planning based on the expected changes. One would look at that change and say, okay, that's coming, because there's no way they don't get this passed. Right? Well,
Sure.
apparently there was a way, but
Yeah.
it was viewed as highly unlikely at that time. So they paid taxes earlier than they otherwise would have. I'd even go further and say there were people, for instance, who sold cottages.
Right.
And, I guess in a situation where they'd been thinking they'd sell it in the next few years, it's like, there's going to be a big jump in the tax on that. Let's sell it quickly. And in order to get a quick closing, because, real estate, typically closing dates are extended. Some of them took a haircut on price. They took a lower price than they otherwise would have. They're not getting that money back. Right. So it's very unfortunate, but it's the nature of the beast.
Yeah.
Go ahead. We've got more to talk about here, but chime in with questions, because there's other aspects we want to talk about on this increase.
Yeah, definitely. So I guess on the capital gains is still, oftentimes when I talk to clients, still is they kind of separate the inclusion rate versus the actual tax rate. So the inclusion rate, to your point, is on every dollar of capital gain you make, you pay tax on 50 cents, and then capital gains is taxed at a much lower rate still than interest income or dividend income. Could you maybe explain that a little bit?
Right. So if you have a choice of the different types of income you earn, lower is better than higher, obviously. So when we look at the different categories of income, we've got the fully taxable items. So that's like, employment income, for instance, or interest income, or payments taken out of an RSP, or more likely a RIF, Registered Retirement Income Fund. They're all fully taxable. Right? And the more income we make, the higher our tax rate is as well. We have to think about that. We have a marginal tax rate system in Canada, where as your income goes up on the next dollar, the tax rate tends to go up in stages, but over to the point where the top tax rate in Ontario is about 53.5%. Now, it's only once income's over above 240 something thousand, but that's where we hit that top rate. The other types of income, we get Canadian dividends, and On them, if you get $100 of Canadian dividends, you actually have to report more than that on your tax return. It's what we call grossed up, but you also get a tax credit to offset that gross up effectively. And at the end of the day, those Canadian dividends are taxed at a lower rate than interest, foreign income, RIF income, et cetera.
Right.
So they're what we call tax preferred in nature.
Mhm.
And then finally, capital gains. As you mentioned, we only have to put 50% of those on our tax return. So again, tax preferred in nature. So a lower tax hit on capital gains than we have on, for instance, interest income.
Yeah, right on, right on.
I should mention, Ben,
Sorry,
because
go
it's
ahead.
important, because
Yeah,
people are going to
go
have their, well, we're getting into tax return season, right?
Yeah.
So there is a wrinkle that is confusing, but it's no big deal. So I just want to mention that, in that the tax slips for 2024 actually have two boxes for capital gains. Gains prior to June 25
Okay.
and gains after June 24, period
Okay.
one and period two,
Okay.
which it's irrelevant, but
Yes.
we have that. And when one looks at their tax return, how that happens, we've got a 5-page schedule where we report our capital gains, and pages 3 and 4 is where most of those the realized gains get reported. Page 3 is for period 1. Page 4 is for period 2. Now, it doesn't matter whether it's period 1 or period 2 from the perspective of inclusion rate. So later on, it just brings it all back together. So the only reason I mention this is that there will be people who look at that T-slip, the T3 or T5, or people who look at their tax return and go, what's going on here? Well, this makes no sense. And they're correct. It makes no sense. But at the end of the day, it doesn't actually matter, because it brings it all back together and figures out your total capital gains for the year. And that's 50% of that is what you're taxed on. So even though it looks unusual, it's not a big deal. And it's just more of a headache than anything else.
So that's a great point. I mean, I think the companies started to adapt and adjust, right, to be prepared for this change, and then now it looks like it's not going to happen. So that's a great point.
There was a lot of work. That's a good point, Ben, that there was a lot of work put in by various financial institutions. So investment fund companies like Fidelity, and all of our competitors and all of the banks, and insurance companies had to do this, and CRA, and all that work was for naught, right? And in fact, to go further, CRA, this was a lot of work for them. And in fact, they still aren't ready to receive tax returns if there's capital gains on them. So, hey, audience, if you have if you're just about finished your tax return and you have some capital gains that were realized last year, or that are distributions from investment funds, so show up on a T3 or T5 slip, you can't file your tax return yet, which is crazy, but that's where we're at. Hopefully very soon, CRA will announce that they're ready to receive them. Now, the trade-off on that is that although April 30 continues to be the technical deadline for anyone who realized a capital gain last year or received a capital gain distribution, again, T3 or T5 slip, CRA is not going to charge penalties and interest until we get to June 2nd. So basically, there's an extra month there of relief. So it's all of this has been very unproductive for financial institutions and accounting firms and CRA itself, but that's where we are.
Wow, that's I didn't know all that. That's good. I appreciate that. Yeah.
Well, you have to look out your window, Ben, there, and that's the people over on Parliament Hill there.
Exactly, taking care of it. Yeah, no, that's good. That's good. Excellent. Did you have anything else you wanted to add on the capital gains before we jump on to the next question?
No, I think there's enough there, isn't there?
For sure, for sure. And before we get too hard on CRA, maybe we have a question just about some of the bearer trust issues that came up last year. We do have some clients. I have some clients that fall into that category. I'm just wondering if that maybe you can provide some color and comments on that, and if anything's changed this year.
Sure. So bearer trusts are a bit of a odd area, shall we say. And last March, a lot of people were concerned that there was a filing due at the end of March, or technically early April last year, that relates to what are called bear trusts. And they might have read articles in the newspaper about different structures and these filings. And Ben, they may have called you up and said, hey, reading about these things and these filings is my situation. And they describe it a bear trust. And your answer would probably be, I have no idea. Speak to your accountant, which is the right answer.
That's right.
And accountants were doing a lot of work on these structures. And then the second last business day before the filings were due, CRA came out and said, no, we're actually going to push this off. These filings are no longer required. It was very late in the game. A lot of people had done a lot of work on these. People had filed, people had paid accounting fees. And then again, just like our capital gains inclusion rate, it's like, oops, that's a waste of effort. So what's happening there is they've come out and clarified things. Firstly, the first filing is actually a year from now, March of 2026. Secondly, they have made exceptions for a number of situations. I'll just give them at the high level. So, but often people will have, for instance, in trust for accounts.
Yes.
So perhaps it's mom in trust for minor child under the age of 18, for instance. And that is likely a bear trust. And previously might have required a filing. Now, in that scenario, for instance, as long as the assets are under $250,000 and only certain assets are held. Now, that asset list is, pretty broad. Stocks, bonds, GICs, investment funds, right? Mutual funds, whether structured as trusts or corporations, they all qualify. But as long as we're below 250,000, the filing's not required. So that actually gets rid of a lot of these potential filings. There's also some on the real estate front where not uncommon, where you have an elderly couple and one of them passes away and the other will add an adult child, in this case, to title, joint ownership, with the idea to get around probate. So it's an estate planning technique. Again, that was going to be caught, and they've now come out and said that, if you meet certain criteria, but that, general idea is that will be off the hook and not require the filing. There's also the flip side of that is the, a 30-year-old buys a home, is struggling to qualify for a mortgage, so they ask their parent to come on title and co-sign the mortgage. And again, that was likely going to require that type of filing and no longer does. So there will still be scenarios where people do have to do these filings, but the number of individuals that have to do them, I think, has gone down fairly dramatically as a result of these changes in the rules. And I'd say that they're good changes in the rules. They should have been done in the first place to get, and these rules were highly complex. They're still complex, but the other final thing I should note before we move on, Ben, is that these changes that I've mentioned, the additional relief from filing, actually haven't been passed into law yet, and we're perhaps about to go through an election. That said, I do think that even if we have a change of government, it's likely they would be consistent. They would say, yes, we're these changes are made, because they would just upset people if they didn't make that.
For sure. Just as we go into the next one, and as you say, people are starting to file their taxes as well. The one thing that we discussed is charitable contributions. Certainly this time of year, everyone's looking for deductions. I know we can't do it for this year necessarily, but maybe you can elaborate. But maybe you can talk a little bit about charitable contributions, taxation, and such around it.
Yes. So I always encourage people, especially late in the year, to think about charitable donations. It's a great way to reduce your tax bill. Technically, it's a credit, but has a similar effect in reducing your taxes. Not identical, I should note, but nonetheless. And this year is actually unusual. So as people are thinking about their tax returns, as a one-time deal, call it, they extended the deadline for charitable contributions to count against last year's tax return. So normally that's December 31st. It's a calendar year. But for this particular, the filing of a 2024 tax return only, they are allowing donations made in January and February to qualify as donations on the prior year's tax return. Why did they do that? Well, because of the postal strike that we had in the fall, meant that charities send out mailers to try and encourage people to do charitable gifting, and those mailers weren't arriving in people's homes, right? So they weren't even getting those mailers till January. So the charities lobbied and they won on this to say, hey, January, February contributions can count against last year's tax return. Mm-hmm. So if you made donations in January or February, whether because of this change or not, you can generally use them against last year's tax return and reduce your tax bill. Now, there are a couple of exceptions. Payroll contributions don't count for this for some reason, nor do in-kind contributions. I can't explain why, because I don't know why they decided to complicate it and make exceptions is beyond me. In fact, I should talk a little bit about in-kind donations because in fact, they are the most tax efficient way to do charitable donations. The concept here is that we have, let's say, an investment fund that has gone up in value in a taxable account, and we want to do a donation. Well, in fact, I did one like this in December, Ben. I wanted to donate $3,000 to a charity.
Yeah.
So I had a choice. I could have given $3,000 of cash to the charity. In prior years, the same charity I had given 1,000 or 1,500 to, sometimes even 2,000, I think. But this year I was ready to increase that donation. I could donate cash like I'd done in previous years.
Yep.
But I had an investment that it was more than $3,000 worth, but that I could say, hey, you know what? Instead, I'm going to donate $3,000 worth of this particular investment, again, in a taxable account. The cost base on this investment was around $1,000.
Wow. Okay.
So instead of donating cash, I donated the investment. Now, what that does is technically it triggers a capital gain, right? My proceeds are $3,000. My cost base is $1,000. So that's a $2,000 capital gain, 50% inclusion rate. I would have to pay tax on $1,000. But because it's a donation in kind, I do not have to pay the tax on that capital gain. I still get my charitable donation receipt for $3,000.
Okay.
Right. So, hey, off the hook on the capital gains tax.
Yeah.
Still get my full charitable donation receipt.
Yeah.
It's incredibly tax efficient. Anyone thinking about even modest charitable gifts down the road should, think about this strategy. And it was pretty easy.
That sounds good. Yeah, I know. I think it is a great way to go about it. And for people that don't know, almost all charities are familiar with this type of transaction. And there's a sheet of paper. Well, it's probably not a sheet of paper anymore. It's probably all digital now.
Yes.
But a digital contract that you sign and goes over to the institution. They transfer the shares and then they choose to likely liquidate on their side, but they deal with the management of it from that point. No, that's a great point and great strategy.
And there's nothing dodgy about this, right? The government put these rules in place to encourage charitable gifting. So we're simply, taking advantage of the rules that they want us to take advantage of. So it's win for the taxpayer, win for the charity.
Yep. Yeah. Perfect. So just as you've been making some references between open accounts and registered accounts a little bit, so maybe we can just talk a little bit about that. Those open accounts, those are cash accounts, margin accounts. This is where people would have their money outside of their registered plans. I just had a conversation with a client today who doesn't want some income in the portfolio, but doesn't want to pay tax on those income in that portfolio. So maybe you can give me a little bit context around how to potentially defer some gains or how that works and just some kind of planning from that perspective.
Absolutely, Ben. So uh, when we're thinking about investments, always the first part of the equation is what's the right investment mix for the investor, right? And that's your job to work with that investor and understand their risk profile and understand the various products that are out there that can meet the client's needs. And then the question is, can we layer on some tax efficiency, right? We talk about the taxation of Canadian dividends and capital gains as being more tax efficient, tax preferred in nature. The tax hit is lower on those than it is on, for instance, interest income. So when we think about a balanced approach where you own both fixed income or bonds earning interest income and equities earning dividends, whether they're Canadian dividends or foreign dividends. Think about that. Well, if you invest conventionally, that interest income is going to take a high tax hit, of course.
Yeah.
There is another structure in the industry referred to as corporate class funds, and they are they have different attributes, which can be good and bad. But as long as we manage them prudently, and so that we take advantage of the good aspects and don't get hit with the potentially bad aspects, and I say potentially because bad aspects don't have to come into play at all. Basically, what can happen is we can, have an investment in a balanced type of mandate, owning bonds and stocks, and yet not have to pay tax on the interest income. Right? And it's a structure that CRA is familiar with. So right, there's nothing dodgy here. These structures have been around. I think the oldest in the industry was started back in 1985. Give or take a couple of years, because I'm not really sure. But Fidelity, ours launched in the year 2000, so it's been around for a quarter century. CRA is familiar with these, and they have worked very, very well. And the only types of taxable income you will get from these structures is Canadian dividends and capital gains. So they pay both of those out from time to time. You should expect both of them, but obviously that's more tax efficient.
So that's good. I'm just going to maybe elaborate just as a point of differentiation, and maybe you can go on from there as well. And I mean, the typical structure for a mutual fund is a trust, like a standalone trust, and each fund has a standalone trust structure, where the corporate class tends to include a bunch of different funds. Is that how it works?
Yes, there are a bunch of different funds within the same corporation, hence the name corporate class. And the key to all of this is it's one taxable entity. And we get to the synergies by having all those investment funds in one taxable entity.
So what if somebody needs the income? Can they pull income from it and not pay the interest income?
So they can get cash flow from virtually any investment fund, whether trust or corporate class. But for taxable accounts, corporate class tends to be the preferred option. That's because investment funds have, in many investment funds across the industry, have the ability to pay out what's called a return of capital. And it's often referred to as T-series, right? Because it was tax smart. And what we're doing is basically someone put after-tax money in, and then it's grown, built up a capital gain. They want some cash flow. Well, they could sell some investments, but that's going to trigger capital gains. So instead, we say, hey, you know what? Instead, we'll give you back some of your own capital. Right? We'll do it on a monthly basis. Maybe we'll pay 5% or 8% of the market value each year. It's never exactly that, but we'll pay that out each year, 1/12 of that per month as a return of capital. And a return of capital, because we're giving you back your own money, it's not taxed. Now, it's a tax deferral. And by the way, I mentioned 5 or 8%. It's not yield, it's not return, it's a rate of cash flow. You're still invested in the same investment fund. We're just turning on the cash flow.
Got it.
Tax-free. And it's a tax deferral. And the way that's achieved is it reduces our cost amount. So we pay you out a certain amount of return of capital, that reduces your cost base. So, down the road, you do have to deal with that capital gain. But as a general principle, we'd rather have the money sitting in your account than CRA's account. And by the way, that charitable gifting effort that I did back in December, you can combine that with this T-series and bring down your adjusted cost base take that money out tax-free,
Yep.
and then do a donation, you don't have to deal with the capital gains tax. So
That's great.
it can actually be put together and give you a very effective tax situation.
Super. Yeah. Well, that's good explanation. Thank you. Like to just switch gears a little bit. And since there seems to be a lot of talk between Canada and the US, maybe we can hit on a couple of those, the potential taxation issues. Again, lots of questions about that. Maybe US stock ownership, and does it matter where you own it? I'd say is one question. And the second, does it expose you to US estate tax?
So let me take those in reverse order.
Sure.
So if we're talking about a Canadian who's not a US person, US citizen, typically we're talking about living in Canada. So a Canadian who's not a US citizen, they can still be exposed to US estate tax, surprisingly. And if you own US equities, shares of Microsoft or GM, whatever, even in an RSP, that is caught under the US estate tax rules.
Okay.
Now, you have to have a very large estate at the end of the day, and to get caught by this. So most people don't have to worry about that element, but you can sometimes the executor ends up having to do a US estate tax return, even if there's no taxes owing. So an easy way around that, Ben, is to get that exposure through an investment fund that buys US stocks. So you wouldn't think that should matter, but US taxation is very prescriptive. And the IRS has said that a Canadian offered investment fund that owns US stocks don't have to worry about the US estate tax. So that's your second question. And the first one, does it matter where we hold them? And the element there to think about is that when a US company pays a dividend to a non-resident of the United States, there is withholding tax. So typically that's at 15%. Now, if it's held within a taxable account, we can get that effectively get that withholding tax back, because we report the amount of the dividend on our tax return, figure out the tax on it, and then we get a foreign tax credit based on the withholding tax paid. So in other words, in a taxable account, that withholding tax is generally a nothing.
Okay.
If we hold it within an RSP, well, if we hold stocks directly, there's actually a Canada-US tax treaty, and we don't have to pay that withholding tax.
Okay.
But if it's held by an investment fund held within an RSP, that investment fund does pay the withholding tax. So you do need to think about that potential additional cost. And I should note, Ben, that there's actually one exception to that. We actually have an investment fund at Fidelity. I think it's called the Fidelity US Dividend Registered Fund. And it's designed to meet the rules of the treaty. So it actually doesn't pay that withholding tax.
Okay.
Yeah. So,
interesting.
And then finally, tax-free savings account. You no way around the withholding tax. Any U.S. equities, U.S. stocks held directly or indirectly in a tax-free savings account will be paying that withholding tax. So lots of things to think about there, and we'll have to pay attention to what the U.S. government does to see whether there's any changes on that front.
Yeah, for sure.
There might be.
Yeah, there might be. Yeah, lots of changes going on. So I wouldn't mind hitting on a couple of corporation questions, and then certainly I wanted to ask you about the CPP and OAS, which we can talk about next. But I'd say maybe you can give me a little bit of context around. I do have clients that have corporate accounts. There is something called a capital dividend account. Maybe you can elaborate on what the capital dividend account is, what it's for, and how you can potentially use it.
Sure. So when we're talking about corporate accounts, typically we're talking about private corporations that have investments. So small business owners, for instance, right? If they earn the right type of income, basically just business income, the tax rate, and Ben, you may have clients in both Ontario and Quebec. It doesn't actually matter. The tax rate on small business income, the first 500,000, is only 12.2%. Right? Very, very low. Now, if someone takes it out of the corporation, they have to pay tax. It as a dividend, that tax it higher than standard dividends. So that offsets that low tax rate. So often what people will do is they'll leave the money in the corporation.
Mhm.
And it's almost like a retirement savings account from that perspective, in that they haven't gotten a full deduction like on an RSP, but they've only paid a small amount of tax on that. So they invest it. Now, those private corporations, unlike on the business income where the tax rate's very low, on the investment income, it's actually very high. So interest income is actually taxed at just over 50%.
Yeah.
But again, here we can benefit if we make investments that where the return is taxed instead as either Canadian dividends or better, capital gains.
Right.
So again, corporate class funds might be an option to think about, but
Mhm.
regardless, anytime we have a capital gain realized, whether because we sold something or we received a distribution from an investment fund in the corporation, again, the 50% inclusion rate applies. So only half of that capital gain is taxed within the corporation.
Mhm.
And the non-taxable portion of that capital gain goes into what you referred to as the capital dividend account. And that's the technical name for it.
Sure.
The beauty of that is that amounts in that capital dividend account can be paid out to the shareholder tax-free.
Okay. Wow.
Now, that's great.
That's good.
That's how the Tax Act it
Yeah.
works. So,
Yeah.
but it's a great tool to take advantage of. So earning capital gains in the private corporation are again 50% inclusion rate, and then the non-taxable portion payout tax-free to the shareholder. I always not just recommend, stress that it's really important to work with the corporation's accountant prior to paying a capital dividend, because it's got to be done properly. But it's a great tool to take advantage of.
Yeah, super good planning tool for sure. I think you hit on that. I'd say one more before we get to the OAS CPP question, which is income splitting. So get lots of questions from clients around income splitting. Maybe you can tell me a little bit what income can be split, and also is there a certain age that you can start to split?
Right. So
yes.
In Canada, unlike the US, by the way, but in Canada, we are taxed as individuals, right? So a couple, each of them is taxed as an individual, and your own tax returns based on your own income. And if you have a couple where one person is making significant amounts of income and the other person's making zero or low, whatever, that tax burden on that is higher than it would be if the two of them were making the same total, but it was split perfectly between the two. That's because of the marginal tax rate system. So splitting income refers to the tax technique of essentially shifting income from one person to the other. And that results in tax savings. So we're shifting it obviously from the high income person to the lower income person. Now, that can be done on investments through what we call a spousal loan, right? One person loans money to the other, but there has to be some interest charged on that loan. So anyone looking to do that needs to make sure it's done properly. That's a whole other topic we could go into. But for retired individuals getting pension income, there is the ability to split pension income. Now, the type of income matters. If it's from, for instance, a defined benefit pension plan, right? So you're paid $3,000 per month for the rest of your life. You can split that at any age. If you're old enough to start that DB plan pension payment, you can split that. So you could say, hey, I'm going to split 50% of that, or some lower number, whatever, and have that taxed in my spouse's tax return. Now, you cannot do the same with money pulled out of an RSP. But you can do something similar once you've converted that RSP into a RIF, Registered Retirement Income Fund. So there's a little nuance there that you've got to be careful about. But the other thing that you need to be aware of is you can only do that. You can only split that income once you're 65. So to me, that's unfair. That rule should be changed. I've actually, on the budget consultation process, I've sent in letters over the years saying this needs to be changed. Because why should someone with a defined benefit pension plan get treated more favorably than someone taking money out of a RIF? But that's what we have to deal with. I should also note that Canada pension plan payments can be split, at least to a degree. that's not so. Those pension income, the splitting is done on your tax return, although CPP is actually done by contacting Service Canada and having them do it. So you have to do it in advance, essentially, whereas the other can be done every year on your tax return.
Interesting. Does it matter how old, like in the RIF case, does it matter how old the spouse is, or it's only the owner of the RIF?
It's the recipient.
Recipient. Okay, perfect.
Yes.
Thank you. So definitely learned a lot. I did want to ask you about the CPP and OAS because it is a question that I deal with, and almost every person I'm doing a retirement plan for is, should I take my CPP or OAS early? Should I defer it to 70? Obviously, every individual is different, but maybe you could provide some context and some thoughts around how to answer that question.
Sure. So when we think about CPP and old age security, the standard age at which people think about taking them is 65. But with CPP, you can actually start it as early as age 60, and you can delay it until as late as age 70. Anytime in that same 10-year framework is when you can start it. But if you start it earlier, they're going to penalize you, right? As in, they're going to pay you less. And why? Because they're going to pay you for more years, right? Makes sense. If you start it later, they're actually going to give you a little bit more. Again, because they don't have to pay you for as many years. And actually, let me just see if I can't share a slide or two. And let's see. Does that work, Ben? You can see that?
Yeah, perfect.
All right. So if we're eligible for the maximum CPP, it's that middle line at age 65, you get $16,000 or so. If you start it at age 60, you only get a bit above 10,000. If you wait till age 70, 23,000 per year, right? But that means you get it for fewer years if you wait till age 70. So how do you think about it?
Yes.
Well, one way to look at it is how much will they pay me over the years, right?
Right.
So I've graphed it out here, right? The blue line is if I start at age 60, 10,000 and a bit per year. Blue line at age 65, 16,000 per year. And of course, because you're getting paid more, it starts later, but the slope of the line is steeper. By age 74, you will have received more by waiting to age 65. And the red line is if we wait till age 70 to start. Again, starts later, but it's steeper because we're getting over $20,000 per year. Now, this is actually a pretty unsophisticated way to look at it because, of course, I'd rather have $1 today than $1 in the future, right?
Right.
I can spend it. Or the other way to look at it, the flip side of the same coin is I can invest it.
Right.
So let me look at that. What if I invest that and I earn 3%, which sounds really low, but that's 3% in real dollars, right? So if inflation's 3%, I'm earning 6% effectively. But I want to think about it in today's dollars. This is why I've done that. Causes the lines to be curved, means the break-even ages are pushed out. But if you live beyond even age 81, you're better off waiting, well, I guess 86 is technically the 86 crossover even for waiting till age 70. And Canadians are living longer and longer. Life expectancy has gone up very considerably in the last few decades in Canada. And people have, higher incomes, live longer than the average too. So, and the final thing to think about is it's not just the individual we need to think about and what's their lifespan, but if they have a spouse, there's something called the survivor's benefit, which is based on the amount that's been being paid out each year. So it really does make sense in many cases to, take advantage of the increased CPP payments by waiting. Now, the reality has been most Canadians do not wait till age 70. 65 is actually the most common age at which to start it. But we have seen a shift over the last 5 years. People have been taking it later and later. So I think that message is getting out there. People are working longer. People are realizing that they have longer life expectancies, so that they're delaying. Very few people actually wait till age 70. It's something
Yeah.
like 4 or 6% of Canadians started at that age.
Okay.
But it's a growing trend.
Yeah.
And it's hard to know what's our life expectancy as an individual, right? We can look at averages, but each of us is an individual.
Yeah.
My grandmother lived to 100,
Yeah.
right?
Yeah, exactly.
My dad passed away mid 70s. However, right, there's a survivor's benefit for my mom, and she's 87, and I think she'll live beyond 100. So we all have to make our own decisions. That's why I would encourage people to have a discussion with you once they're, getting into retirement. And old age security, you can't start it early, but you can delay it beyond 65. There, we also have to worry about what's called the clawback, right? If our income is above a certain amount in a particular year, we have to pay some of that back to the government. It's like a big jump in our tax rate. So for 2025, I believe it's around $94,000 of income. Above that, you're subject to a hefty tax rate. So you've got a combination of, hey, do I delay on that one or start it at 65? And what does the clawback mean? So if someone keeps working beyond 65, for instance, there's a good chance
they should probably wait.
Good chance it's going to get clawed back, and they would, if their income's well above 94,000, for instance, they should definitely be waiting. If someone retires at 65 or earlier, that's a more individual decision.
For sure. Well, that's the last question I have for today. Is there? There is a lot there. That's awesome. That's been super detailed. A lot of good information. Sure, lots of people are going to learn and appreciate what you've given today. Is there anything that you'd like to add or comment on that I should have asked you today that you don't think we covered that's very important to discuss?
Well, there's a lot of complexity to tax, of course, so we could, there's lots of other rabbit holes we could go down, but I think we've covered the big ones. It's expected we're going to have an election. Soon is the expectation. We'll have to wait and see. But anytime a government changes, there's a lot of additional tax changes, so we'll have to keep our eyes on that. Even if the Liberals are reelected, I would expect some more tax changes, especially in the tough economic environment that we now seem to be facing because of what's going on south of the border. So stay tuned. I encourage investors to speak to Ben regularly about tax strategies and things that are changing in the tax world.
So if anyone's looking to find any information on you on your LinkedIn, do you do any of the other platforms? Would people go and look you up?
I just do LinkedIn, although we sometimes do videos, although generally they're for financial advisors, but sometimes they can be sent on to investors.
Perfect.
But and we often send out communications about tax changes as well, but then you would see those and be able to send them on to your clients.
Fantastic. Peter, well, thanks so much. I really appreciate the time you spent. Eva, if have you jump in here and wrap it up for us, please.
This was such an insightful discussion. Thank you, Peter. Thank you, Ben. We don't have questions, so I think it was very clear.
Yes.
You can watch the playback of this on our YouTube page, our Hart Investment Group. Subscribe, like, and comment. Leave your questions if you have after this session. For our clients, please reach out to me if you have questions or if you'd like to book a portfolio review meeting with Ben. Thank you very much for joining us and have a good day. Bye.
Thanks. Take care.
Thank you.